the Euro USD. So we're going to talk about that. That's a big thing, especially if you've been around for some time. So we're going to talk about that. Also going to talk, of course, what's going on with all the other markets. So why am I so excited today? Well, the euro dollar, as you know, has just been trading sideways, and it's been very, very boring since 2018 in May. At least if you're a trend following trader like I am. If you like to buy the dips and sort of grab 2-3 pips here, then this has been a very nice market for you and very forgiving. Even if you don't get the market, the entry right in the beginning, you'll probably see the price sort of venture back into the range where you were at before. So it's very forgiving. Now, if you're a trend follower like I am, this is when you get in trouble. So I only traded this market a few times over the last 12 months. And full disclosure, I'm not necessarily holding a position here, but I'm holding a position in the dollar index actually, which is about 50% made up of the Euro USD. Now, what's interesting here is that yesterday we had a close below 111.75, and this of course should not have come as a surprise for any of you guys that have been watching this presentation, because I talked about this level for quite some time, and I also talked about how the GBPUSD was bearish and dollar yen was bullish, and any surprise. Now, going forward here, I think we're going to continue to trade lower, and as long as you trade below this high, which is 112.26. Now, it's not the best of patterns, but you can interpret this like some sort of a double bottom and this like some sort of a double top. And the difference between that high and that low is about 267 pips. So the break to the downside should really open up for that. But it's not just here. If you look at something like GBP versus the USD, then we talked about this being a descending triangle, which it is, like 1, 2, about 3 lows, if not 4 lows, pretty much at the same little spot. And the difference between that high and this low here is about 256 pip, which suggests, and that will be the target on the break here. And this going down with 2.2%, you know, this move here is about 2.4. So it's not a big difference here. So you have this funny looking rectangle-ish pattern, and then you have the GBPUSD, you have the New Zealand dollar versus the USD as well, which is in a rectangle pattern, and then you have the dollar index itself, which is in a massive rectangle pattern. So definitely bearish. Like even here, the interpretation from this section here from March 20th until now could be viewed as some sort of a descending triangle as well. It's just that you get slightly less of an aggressive target here. So what's the plan going forward here then? Well, the best idea would have been just to short on the break here. It would stop just above the high, just because the risk reward ratio was really good at that time. You see the potential profit here was 258 pips versus the potential risk of 56 pips. Take the profit, divide that by over the risk, gives you a risk reward ratio of 4.61. So that is a solid risk reward ratio, which I don't mind taking a shot at. Risk reward just like that, and I did that in dollar index, where the risk reward ratio was relatively similar, if not better. I think in the dollar index, risk reward ratio was about, yeah, about 4 times. It sort of depends. Let me see here. Actually, I had my stop loss here. Let me see if I'm correct. There we go. Yeah, my stop loss is pretty much here. So risk reward ratio is about 7. So much better than the Euro USD setup. Sorry about that. I'm still struggling with a cold. Yeah, so let's move along here. And so with the Euro USD, I think here, if you have that corrective pullback, I think people will try to sell if that ever happens. So further move to the downside, we could easily correct, guys. Don't be surprised if it does. And I think if we go up, people will sell. Much like the dollar versus the pound, where the market declined, we could have shorted here on the initial breakout, and if not, short on the day after on the corrective move. Now I think we're moving away from this level now, so we could potentially test the breakout point. But if we just continue to go lower, maybe to 28.52 or something like that, I think the stop loss could be lower to just above the yesterday's high, and in essence you will be dealing with a, I think, about 15 or 20 pip stop loss at most. As for the dollar yen, it's under pressure. It really never took off. It did have a break very late yesterday, but it never really took off. My new trend defining level though is here, which is just below yesterday's low, and the idea here is quite straightforward. Stop loss was here initially, it's now here. Take out this level. It's not going to change things in a dramatic way. We're probably just going to go a little bit lower. We might still have that head and shoulders pattern, but for now, if we trade below this, I will deem this head and shoulders pattern as a false breakout. Not only did we have the break on April 12th, yesterday we had a false move to the upside, which was quickly pulled back. So if I would have bought here at the original break, I say here, and I had my stop loss here somewhere, I would now reduce it here, because there's also something called a time stop. And most of the things, most of the markets, if they're gonna go the direction you want to go, then most of the time they tend to do that relatively quickly. They don't necessarily spend a lot of time here, because you want to enter at a level which is going to affect a lot of people, and the momentum sort of just kicks off and it gets really busy really quickly. It's not really happening here. So this is the new trend defining level. It is perfectly fine. I do think some people are buying here with stops just below, but my preference is for the market to go up like that. Okay. As for the price of gold, it's still in this head and shoulders pattern. It's just that it's taking a bit of a break, I guess. I think that's what we can call it. So from the breakout point, we still have that massive head and shoulders pattern, head, left, right shoulder, and you had that initial break here. And what I would have done here, I actually shorted pretty much at 1280, and that's my first position and my biggest position. And I have my stop loss at entry now. And this little section here, you can interpret that like its own little range bound market, where around these highs people like to sell, and you know, we might pop above here, might retest that trend defining trend line, or that that trend line from the head and shoulders, and you know, we might just go up and then go down. I still think we're gonna go down. The way the dollar index is looking right now, I think that's the most reasonable, or that's the most likely scenario. However, though, on a break to this high here, my journey with this market would end at that point, and then I would wait for maybe some new pattern to develop here, and you know, maybe at a later stage potentially short sell and target these levels. That's what I would do. These are crude oil prices, and the market is at a very elevated level from a risk-reward ratio perspective. It's still bullish. Still might go up to 66.97, which we talked about, I think, March, February, and might even go higher. It's obviously underpinned by the idea that I think on May 2nd, all the exemptions given to countries that import oil from Iran, they will end, and will most likely end on May 2nd. And the idea here is that the United States wants to put pressure on Iran. And the idea is that some of these countries, like say India, for example, and also China, they will need to buy their crude oil from other parts of the world. And the idea is this: if you're dealing with Iran and import the crude oil, then you can't deal with the U.S. And the U.S., as you know, is a big importer. They have a huge trade deficit, and it's a very strong market that people want to sell into. So they don't want to be not allowed to deal at that market. So because of that, I mean, I'm not sure what's going to happen, but people will probably try to sort of, though that's why crude prices are going up here, just because OPEC would need to commit to that additional supply, which they have actually said that they will do. But I think until they get some sort of firm commitment, I think it's probably going to remain elevated, the prices. As for us, from a technical point of view, again, those macro fundamentals are driving price upwards, but I still think it sort of makes sense to look for a dip. I think at best we can reduce the trend defining level a bit to 63.43, but that's pretty much it. S&P 500, we talked about buying down here lately, and the original entry was here around 28.97. That day was a profit up here. If you haven't done so, probably a good idea to chip some off, 50%, 75% or something like that. and then look for pullback really. Definitely not go short. Today, just today, look at this. This is the Nasdaq 100 at a new all-time high, intraday all-time high today. Again, there's not a lot of talk about it yet. There's people, especially in Twitter finance, that don't understand what's going on, and you know, as long as it continues to be like that, and people are sort of not understanding the situation, and then people will continue to short sell. And it's not. Listen, if you look at the price, it's going up, right? So obviously someone is buying, and the majority, I guess, is winning. But it's more us, because it's quite interesting. It's something I noticed over the many years. Like, either you don't know too much and you just follow what your bank is telling you. So you set up maybe a monthly investment into, say, ETFs or mutual funds. So every month, a portion of your salary goes into here. For example, in the Nordic countries, it's very popular, but also here in the UK now, I think employers need to, or the employees need to commit, I think, 3% of their salary into funds, because they need to be able to have some sort of a pension, because the government doesn't support you as they used to. So you have that, the passive investing, they buy every month, and that is definitely a viable, I think, a viable strategy. And then you have people that are a little bit more active, that go in and out. But then you have people that trade CFDs and spread bet like we do, and that have access to all these fancy charts and go in and out. We know about our technical indicators, and we read up on the news. Is when you go from that level of knowing nothing to knowing a little bit, that's when you start to create errors. Because if you look at how most, it's not, I wouldn't necessarily say is like this for all of the futures, but most of the time, it would not surprise me if the average retail trader that does what we do is actually not short here. I can definitely tell you that the average retail trader is long the EURUSD right now. With a broker I saw yesterday, I think 80% of all new positions were buy positions. So obviously people are making money, but in our group, in our class, people that do this, they're not necessarily making money in this, because they're making all these mistakes. They try to apply real life experiences and the way the markets and things behave in the real world to the financial markets, and the financial markets are not goods that behave in the same way. If this is the price of an iPhone or something like a house, it goes up and up and up and up, with 33% in a short period of time. You're probably gonna try to sell. You won't necessarily buy more. But when something like this goes upwards, people want to buy more of that. Very good example of that is, for example, the price of Bitcoin. When it was going up, everybody wanted to buy, because everybody's looking at this and said, oh, the easiest way to make money is just to buy. So they buy, they make a little bit of money, then they buy, and then eventually, obviously, someone is gonna buy at the very high, and then they're gonna lose out on that specific trade. But that strategy of following the trend, if you do that successfully, like I've been doing since 2014, then it is actually a profitable trade strategy, and that's what I try to apply. And doing the opposite, betting against these moves, is usually a bad idea, especially in stock markets, because 70% of all years in, say, the last 100 years, the Dow Jones is trading upwards. So the likelihood that you get it right on selling for an individual year is just 30%. But there's a 70% likelihood that you make money if you just hold on to the stocks. Buying dips like this, that's usually a good idea, but selling at the highs, not a good idea. Okay, DAX 30, almost at that take profit level. It's a bit overbought. I think we need a bit of a pullback, maybe 12,112, and I think maybe from there people might look to buy. If you did buy on the breakout here already on April 2nd, then you should have a very nice profit. The issue ratio was 5 times. If you close out today, you should have about 3.87, so very close to the high. So I would personally start to maybe close half of the position or something like that, and then maybe buy it back on a pullback, or just ignore this market for a while and just see how far it goes, and maybe just try to allocate capital to other trends and instruments that are just starting to trend higher. Okay, chat box is working today, so don't forget to say hello. So we got that restriction off, so you are most welcome to say hello. We don't have any questions right now though. As well, don't forget to like that video. 3 likes right now, 9 people watching. Please like the video, and all of you guys that are gonna watch the recording, I think there's about 60 to 70 of you guys that watch this every day. Don't forget to like, and don't forget to subscribe to the videos. As well, as you know, this presentation is brought to you by ATFX, and they're a great broker with some really good spreads. So if you're looking to lower your costs when it comes down to trading, especially if you trade the major markets and even the minors, you want to check this out. On GBP pairs, they're sometimes better than the biggest broker in the UK. Very tight spreads. They're up and coming, so they know, in the UK that is, so they know that they need to of course be competitive. The retail edge account, those are the spreads you want to be looking at. This is for anyone that deposits a minimum of 5,000 euros, $5,000, or 5,000 GBP. If you don't perfectly qualify, I have already helped a few guys to access this. For example, I had a trader from Greece that knows me from my time at FXCM and Amana. He just opened up with them about 4 weeks ago, and I helped him to get the edge account, even though I don't think he fully qualified for it. So you can always just text me or send me an email to Alejandro Zambrano at ATFX.com. As well, we're about to launch a new educational course, and that should be live in about 4 weeks time. It's going to be available for the client only webinar, client only portal, and that's something I will produce. It's a very good way and cost effective, because it doesn't cost you anything to get that course as long as you're an ATFX client, and that could potentially put you into faster reaching your goals if you're struggling with your trading. Okay, I think that's it. I think we're gonna wrap things up. Guys, thanks so much for watching, and don't forget to subscribe, and I'll see you guys tomorrow, same time here at 9:30 a.m. London time. Thank you.